around that we are actually expanding our reach a bit. We're pleased to have some members from Western Michigan with us, and also some that have found us through the Institute or through Facebook. For all of you candidates out there, apologies that the exam is also delayed, but we're pleased that you can continue your education along with us by participating and meeting with our speakers. It's great that we have that opportunity for the live Q&A with those individuals that have agreed with this format. You can stay tuned with other offerings that we have on the calendar of the CFA Society of Detroit website. Take a look there. We're also posting a few things you might be interested from fellow societies and also from the Institute. As you may be aware, the Institute had a big conference, and they've agreed to make a lot of those material live to all the members, so please check it out. For those of you that are here in the Midwest, or at least in the Michigan area, I hope you had a chance over the weekend to kind of view some of that pure Michigan weather that we had. I like to go to some of our local state parks and go hiking. At least hopefully you got out to the backyard, saw a little sun. But it does remind me that we're all in different stages of lockdown. When I speak with my family in England, they're really not allowed to leave the neighborhood. And I recognize that other parts of the United States have various degrees in which they're opening up their markets. And so I think that today's topic is very timely in finding out how the markets are doing, so that we can kind of avoid some of that home bias that sometimes we get from the current situation that we're in. And so today I'm very pleased to have with us Andrew Opdyke. He is with First Trust Economics. He's a part of the First Trust Economics team. His responsibilities include analyzing the economic indicators, writing economic commentaries, and also producing articles on the First Trust Economics blog. The team in which he belongs has a very impressive list of awards. Bloomberg has ranked the team as one of the top forecasters in the U.S. economy. They've been awarded the Crystal Ball Award by Zillow in partnership with Pulseonomics several times for accurate home price predictions. And Cogent's 2017 survey of advisors rated First Trust thought leadership materials as #1 most read and most shared by advisors with colleagues and clients. Andrew has received his MBA from Northwestern University Kellogg's Graduate School of Management and a BA in Business and Economics from Hope College. He is a CFA charter holder and a member of the CFA Society of Chicago. And First Trust has been a long time supporter of the CFA Society of Detroit. So we're very pleased to have you here with us today. With that, I'd like to hand it over to Andrew.
Perfect. Thank you so much, Julian. As you mentioned, we had a beautiful weekend here too in Chicago this past weekend. I hope everybody got that chance to get out. I would say, we are also still in this lockdown phase right now. And I hope, you may be seeing similar things. I haven't seen more people outside going for walks, going for bike rides, wearing the mask, taking precautions, but we're slowly getting back outdoors, even in these places where that slowdown, that shutdown, the shelter in place is in effect. Now, this is going to be a big week for economic data, because at the end of this week on Friday, we get the jobs report. Now, the jobs report Friday morning, it looks like, based on the data we have, the initial claims data that comes out each Thursday, and the continuing claims data that we get on how many people continue to be receiving unemployment benefits, it looks like we're going to see about 22 million jobs lost in April, last month. Now, for a little bit of perspective, if we see a number like that, 22 million jobs lost in April, that's going to put the unemployment rate at around 17%. If we go back to 2008, 2009, over that period of 18 months, really kind of up to 24, it was in 2010 where we hit the peak in unemployment. We hit the peak in unemployment back then at around 10%. And in the early 80s, 81, 82, which was another particularly severe recession, it hit about 10.8%. So we are seeing a larger and faster drop over, again, 0809. That was around a year and a half, 2-year period. We're seeing this in a single month. Now, this is kind of amazing, because if we step back right now, just over 2 months, let's go back to February. And if we go back to February, at the beginning of this year, the economy was growing at about a 3.1% annualized rate. Now, if that had continued through the year, if we had seen that 3.1% rate for all of 2020, that would have been the fastest year for economic growth since 2005, before 0809. Now, we already saw last week, we got our first look at first quarter GDP. It was growing at that 3.1% rate through January and February. The shutdown, the slowdown that we see around us resulted in that single month of March moving us from a positive 3% to a negative 4.8% pace of growth in the first quarter. In the second quarter, it's going to be uglier. Now, the data reports with a lag, so we won't know exactly how ugly it got for another 2-3 months. We won't get our first look at first or second quarter GDP until July, at which point the time that it's telling us about, with April, I believe, going to be the worst month from that situation we should be in when that data gets here should look very different from the data it's telling us about. But if it looks like we could see an economic decline of 20 to 30% in the second quarter, which that would be the largest decline for any given quarter, basically going back to the Great Depression. But I want to be clear from the beginning that I do not think this situation is the Great Depression. So let's talk about that a little bit. When we are evaluating the economy, whether it was before all of this started, throughout this situation, or what we'll be using moving forward, we use what we call the 5 pillars of prosperity. These are what we view as the economic fundamentals. So let me see, I want to make sure I can highlight these. Let's talk about where these were going into this situation, and let's make some comparisons. Now, these pieces, monetary policy, tax policy, trade, government spending, and regulation, when they're moving in a positive direction, when they're supportive of growth, we see growth in the economy. When they are moving in a negative direction, it's that headwind to growth. And if enough of them are moving in a negative direction, then we've seen recessions. Now, coming into this monetary policy, we're thinking the Fed and interest rates. The Fed had started to raise off of that zero lower bound that we were at in 0809. We all know we're back there again now. But in the intermediate period, rates had kind of risen, then they had started to move a little bit lower. There was some movement over the past 2 years as we had concerns over things like a government shutdown or the escalation of the China trade war. So with some of that uncertainty, the Fed had lowered rates, and I would say coming into this year where rates were at among the lowest levels that we've seen in decades, monetary policy was accommodative. It supported investment. We saw some of that in 2018. 2019's major headwind was some lack of clarity on what was going on with that China-U.S. trade dispute. Companies were waiting for that uncertainty to subside a bit before increasing and allocating. But monetary policy, if you talked with businesses as the Federal Reserve, who has branches all around the country, they talk with their local business groups, with the leaders, and ask them essentially, is the rates that we are seeing today, are those prohibitive or supportive of you making investments? And essentially the respondents, and they published this data, said, well, it's not really a headwind. This is still among the lowest levels we've seen in our careers. It's other pieces that are slowing investment. So monetary policy, I would argue, was moving in a positive direction. Now, tax policy and regulation have been moving kind of together over recent years. We had, in 2018, we had the tax cuts. We saw corporate tax cuts. We saw individual tax cuts. Now, tax cuts should incentivize business investment. On the individual side, when you're taking home more of each dollar that you make, that should be incentivizing work. So we saw these pieces put in place. We did see in 2018 in particular, we saw that pick up in some business investment. Coming into this, going back just to February of this year, we had an unemployment rate of around 3.5%, lowest levels that we've seen since the late 1960s. Now, on the regulatory side, in 16, 17 into 18, we were looking at the rules on the books, and we were trying to determine what was antiquated, what needed to be changed, and what was overly complex. Now, regulations, there are necessities with the regulations. It's not to say regulation should go away completely. There are rules and regulations to protect individuals, to protect businesses, but there was a certain point where some of them got overly complex. And you have people who, let's say, small, medium-sized business owners who know how to run a farm, they know how to run a store, they know how to run their company, but they're not CPAs, they're not lawyers. So when it came time to addressing the tax code, the labor code, they would have to bring in outside resources because it was too complex. Now, we can call this the cost of doing business. It was a necessity for them to do to stay compliant. As those have eased, it reduced the cost of those operations. It reduces that barrier to entry or the cost of doing business and allows for reinvestment in other parts of the business. I would say tax policy and regulatory policy, they've moved in a positive direction between 16 and 18. They've been a bit stagnant. They haven't really moved for the last year and a half. And there was questions on what impact the upcoming elections might have. We'll talk about that towards the end of today, but they were moving in a positive direction. Now, if we were talking 6 months ago, and actually this morning, this is coming back up as the topic, trade policy. Right, last year, throughout 2019, and really for the second half of 2018 as well, this was a key focus area. There was the China trade dispute. I'm not going to call it a trade war. I would say it was a dispute with one country over some sets of products. But towards the end of last year, we started to see a little movement on that. We got the stage 1 trade deal, and there was discussion starting towards a stage 2. That was getting the media attention. That was making the headlines. I would say more importantly was the progress we made in new trade deals with Canada and with Mexico, our numbers 1 and 2 trade partners, and then with Japan. Now, Japan is our 4th largest trade partner. We came to a new deal with them. If you take Canada, Mexico, and Japan together, the amount that we sell to those countries is roughly 4.5 times larger than the activity we do with China, but all of the attention got shifted onto that China trade dispute. Now, that started to ease coming into this year. I would say on net, we've been moving in an improved path on our trade front. And don't forget, at the end of January, we had the United Kingdom leave the EU. They were in line in discussions to improve their trade deal as well when everything hit with the virus. Now, the China side, it's getting complicated again. It may cause some ripples, some volatility, but on net, we're moving in a positive direction with our trade policy. The one area we had some concern about was this government spending. Right? They've been running deficits year in, year out. We continue to increase the size of the debt. This seems to be one of the few bipartisan agreements that we will continue to increase the size of our debt. And I believe that that's a headwind. It's a negative factor towards growth because the more money that goes towards the public sector, it has to come from somewhere. It comes from the private sector. Now, I believe that the incentive structure towards entrepreneurship, innovation, growth is better in the private sector. I think we've seen other countries, particularly some European countries like France, they've seen slower economic growth over time. And I think that is attributable, at least in part, to the larger size that the government plays in their the role of developing and progressing the economy. But here we stood in a situation with 4 positives, 1 negative, 1 headwind, and I think these were the fundamentals underpinning that growth of around 3% to start the year. So coming into this year without the coronavirus or COVID-19, the fundamentals suggest this would be another year for growth. Now, we've seen, and I'm talking to you from Wheaton, Illinois, 26 miles straight west of downtown Chicago. And from where I am in our building, because I am in the building right now, on any given day, this building that has normally about 500 people, on any given day, I usually see maybe 5. We have 95% plus of our staff working from home. There's some people here and other floors, but I don't really see them. But from where I sit in the building, I look out over our downtown. Now, directly across the street from our building, we have 7 small businesses. There's a pizza shop, there's an ice cream shop, toy store, arts and crafts, hardware, bikes, flowers. And I've been watching these businesses for a while, well before any of this started. I've been at this spot in the company for about 10 years. And I would watch during the day as first the employees would show up in the morning and unlock the doors and start preparing for the day. Then I would watch as the customers would trickle throughout the day. They had steady customer bases. These companies, they've been here in many cases longer than I have, continuing to operate as going concern businesses. Now, what we've seen over the past really 6 to 8 weeks, before the shelter in place went into effect, before the stay-at-home orders, we started to see a slowdown in traffic. Concerns started to arise as we got more information out of China, and then it was spreading to South Korea and Italy and to Iran, and we started to hear more information about the disease, more concerns that it could show up and likely would show up here in the United States, so people started taking precautions. They were staying at home, particularly if they were elderly or had pre-existing conditions that made them more vulnerable. But they were taking precautions, and that was slowing the traffic through the downtowns. Now, once we got that stay-at-home order in effect, there was a drastic slowdown in business activity. From my seat, watching over these businesses, I could count with my 2 hands, I could count the number of people walking through those doors. And that continued to go on, and I started seeing fewer and fewer employees coming in the morning. Instead of 6 employees at the pizza shop, all of a sudden there was 2, because they didn't need 2 people bussing tables. You can't eat there. And with the businesses not operating in downtown, many of those were the people that would come in for lunch. So that slowdown in traffic, they needed fewer people preparing food. They needed 1 less person taking orders. So they had employees who were sitting at home. I saw this as a trend across these businesses, and really over the last 2-3 weeks, I've seen more and more of them close their doors and put up a sign that says something along the lines of, "We try to stay open to support the community, but now we're closing our doors temporarily until this shelter in place is lifted." Now, these fundamentals that were supporting growth, we've run into this shutdown from the medical necessity side. We talked, it had a dramatic impact in March, and it continues to grow. We've moved into a recession, and that's where we are at right now. We're in a recession despite the fundamentals of the economy suggesting we shouldn't be. Now, if we do this comparison, because the data from an unemployment rate and the job loss to the size of the impact on the economy, the only real time for comparison on that is going back to the Great Depression. But back then, all of these were pointing in a negative direction. Monetary policy was overly tight, and they were in a deflationary environment. They were raising taxes, raising regulation, raising spending, trying to have a government control over the economy. And at the same time, they had a true trade war. The Smoot-Hawley Tariff Act was a trade war across countries, across products, compared to our situation, which was with a country on some products. This situation is what caused that recession to become a depression, a prolonged downturn. Now, I think with the fundamentals coming in here and the fact that these companies that I look at across the street, they're not shut down because they had a bad business model. They're not shut down because they had bad products or bad services. Their employees are not at home because they were poor workers. This came about because we're seeing really the first government-induced shutdown. This is really the first government-induced recession that we've seen. That's what's moved us into a negative growth environment. But the government, they have 2 threats that they need to kind of try to balance. And it started, both of these invisible threats. The first was the virus. So we get the virus, it starts to spread to the United States. The early models coming from the medical community, who we look to for the lead in this situation, they said we could see 100, 200 million Americans contract the coronavirus. Now, the World Health Organization was saying that the mortality rate was likely between 2 and 3.5%. So you bring those numbers together, and it suggests somewhere between 2 and 7 million individuals could die from this virus. Now, those are catastrophic numbers. So we look at this and say, well, how do we address it? Well, what you need to do is first identify where it is and contain, but we didn't have the identification available, so we went to this containment that we're seeing in the world around us. Now that brings the second invisible threat, and that second invisible threat is that destruction that comes to the economy as we're shut down, as people are at home. We're seeing that now in the numbers like the unemployed, numbers like the GDP contraction. Now here's a picture I want you to put in your head. The economy is like a muscle. Okay, so we have muscles. Mine, I'm an economist, so it's not that impressive. But you think about muscles, you can build them up over time. There's things you can do. You can lift weights. You can eat healthy. You can grow them. You can make yourself stronger. The economy, on a similar vein, right? It gets tested through competition. It gets strained. It develops over time. The entrepreneurship, the innovation, the new products and services, they allow us to produce more, and we continue to have that grow and grow and grow over time. It's not always steady. There's ups and downs, but we've grown this economy. We've strengthened that muscle over time. Now, when you have a muscle and you stop using it, when it goes without use, what happens is it starts to atrophy. The muscle will start to deteriorate from that non-use, from that non-testing. That muscle will weaken. And the longer that period in which it's in non-use, the greater that deterioration will be. Now, that's not to say that you can't rebuild the muscle. You can rebuild it back to where it was, and you can make it stronger than it was before. But the longer that process goes, the more difficult and the more time it will take to get you back to where you once were. Now, when I look at that from an economic perspective, I think about the companies like what I'm seeing across the street, because that deterioration that happens is things like job loss. Those doors that move from shutting down temporarily to something more permanent, the jobs that individuals don't have to come back to, that's deterioration in our output, our production. And it takes time for new businesses to form, or for the other businesses to recover to a point where they're expanding, they're hiring more workers. So the longer that we're in this shutdown period, and each day, each week, each month, we're seeing more companies get to a point where they will not reopen their doors afterwards. The longer that is, the more U-shaped the recovery will be rather than V-shaped. Now, these companies, they differ. I'm looking here at non-financial corporate assets and debt. So this is non-banks. Now, this includes small, medium, large companies. Now, one of the things we know is that larger companies tend to have better balance sheets. They have more access to the credit markets, the debt markets, to equity. They have better relationships with banks. From an economic perspective, who is in the best position coming into this to grow coming out of it are companies with strong balance sheets, low debt, high cash. Now, we've seen over recent years, yes, debt is at an all-time record high coming into this, but so are assets, and assets were rising faster than debt. We know that a good chunk of some of these assets that were on the books were cash. Those companies with the low debt, high cash, they've weathered this storm before. If you go back to periods like 08, 09, and you look at who were the strong growers coming through and out of the recession, these are the types of companies that strengthened through that environment. Their balance sheets were healthy. The companies, their competitors, that had weaker balance sheets, higher debt. Some of those do go under. These companies buy up some of those companies or buy their assets on the cheap. They take market share, they grow. Now, the bigger concern is those small and medium-sized companies, because they don't have the same strength in their balance sheets. They don't have the same access to the credit markets or the same type of relationship with the banks. Now, let's set aside real quick, let's set aside the PPP program, the government's response through the stimulus. Before we found out that existed, that it was coming into being, the banks started to talk with small, medium-sized businesses, and they asked them, they said, how long can you survive in this type of situation where you're seeing 80, 90% declines in your revenues and the activity coming to your businesses? And 1 in 5 of these small, medium-sized businesses who employ 40 to 50 million people nationally, 1 in 5 said, I don't know if we'll make it past a month. The median small, medium-sized business had 27 days of cash on hand. Now, if you extend out that timeline, how long can you survive? When they got to the point and said, how many companies can survive past 3 months of this type of environment? Half of the companies said that if it goes beyond 3 months, our temporary door closures will become permanent door closures. So now we bring stimulus in. This was meant to address this group, the small and medium-sized businesses. So we got the PPP program, or PPP, the Paycheck Protection Program. It started off about $349 billion allocated. They told the small and medium-sized businesses, go look at your books for 2019. What was your employee cost? What was your rent? What were your utilities? Figure out the average of those for a month in 2019, multiply it by 3. You can get apply for a loan for one of these loans, and then you use that money to pay those things, utilities, rent, and most importantly, your paychecks. You keep your employees on the books. 75% of that money needs to go towards your employees. Now, that initial allocation, $349 billion, it was snapped up in about 2 weeks. There were still companies in the queue when that money ran out. Then there was this stretch around a week while Congress renegotiated. They wanted to add more money in. There was some fighting about what else should get included in that bill, but eventually they did pass it. Last week, Monday, we got about $300 billion more added in. Right now, through yesterday, we've already seen about $170 billion of that accounted for, and we continue to see there's companies in the queue. It looks like that number may get hit. It may get all paid out again. Now, they're starting earlier discussions this time to avoid a situation like last time. But that was the response. It said, what can we do to get you from point A, this shutdown, to point B, you getting back on your feet, recovering, operating as a business? Because as we've seen, we have some states that have started to reopen, but those ones that have started to reopen, if you're a restaurant, if you're a bar, you're operating at most at about 25% capacity. Now, this PPP is helping you. It's blunting the impact, but it's not getting you back to where you were. And as we get further into this, as we get closer to the end of that period that you got the loan for, if you're not back up and running, you're still going to be fighting that concern of, can we keep our doors open? But again, this is meant to blunt that impact, to lessen the damage. Now, I mentioned that 70 to 75% that goes to employees, so let's look at them. Well, let's compare to 08-09. There's 08-09. That was the fundamental issue back then. We had consumers taking on increased leverage, buying more expensive houses because we all knew that the house prices would continue to grow up. They were rising, and banks were offering things like ninja loans, no income, no job application loans. Doesn't matter if you have work, doesn't matter if you have the income or credit history. Let's get you started in this process. And that worked until it didn't. And then we went through the 08-09 recession. There was forced deleveraging on the part of the consumers. This was a traumatic experience for a large number of people. Those foreclosures, the bankruptcies, it was very painful. The loss of credit access, the obliteration of credit scores, it caused a lot of damage. The banks were undercapitalized. But the people who got stung back here over the last roughly 8 years, as we've been recovering going into this situation, the people who got stung before said, I'm not going back there. I'm not making that mistake again. Now, one of the good pieces of news coming into this situation is that consumer leverage, their obligations as a percent of disposable income is your after-tax income, it was among the lowest levels that we've seen in decades. Now, some of these people will benefit from that PPP program. They have their jobs. They are continuing to get paid. For those that their companies don't have access to that, they're not benefiting from that program. We've expanded unemployment. We've made it available for longer. You get paid out more, and it's available to people who previously didn't have access. Those are the pieces on the consumer side to blunt that damage. But both of these, on the consumer side, on the individual side, it's like a tourniquet. It's meant to slow the bleeding, but it's not fixing the root core of the problem. In order to get these companies and individuals self-sufficient, we need to get the doors back open and get the economy growing again under its own power. Now, up to this point, that focus here has been on the medical side, because as we talked about earlier, that medical need, the potential medical outcome, the cost of lives was enormous. Now, those numbers, the 2 to 7 million deaths, was if the disease was left unchecked, and clearly we haven't left it unchecked. We've been working, growing, taking actions to minimize the impact. Now, before we didn't have the identification, so we went with the containment, so we focused on identification. Beginning of March, 2 months ago, we had run less than 1,000 tests nationally. Between March 4th and the 11th, it went from just under 1,000 to 7,600. Next week, it was up to 76,000. Then it was up 470,000. We ended March with just over 1 million tests given in the United States. In April, that number rose to about 6.2 million. And for the last 5 days, we've been adding between 200,000 and 300,000 tests per day. We just passed 7 million tests. And we continue to add typically around 200,000, 250,000 tests per day. Now, we have a large population. There's definitely room to go. But what that's allowed us to do is start shifting some of the focus. When testing is limited, we limit the tests to those showing the clearest symptoms. And the people like the frontline workers, the doctors, the nurses, the paramedics, those most likely to have the disease. As it continues to grow, we continue to move towards testing being more broadly available, and it's testing on individuals showing fewer symptoms. Now, we know from the data so far that especially in the younger generations, your teens, 20s, 30s, 40s, 50s, without pre-existing conditions, the symptoms vary widely and they can be far less severe. In many cases, it's believed people are asymptomatic. They won't even know they had the disease. And if they were showing some of those minor symptoms early on and they went to get tested, they wouldn't have had access to a test. Their symptoms were not yet severe enough to justify the use there when we had the severe cases there to be tested. So we started to ramp that up. Our numbers here in the United States of confirmed cases rose along with it. Because in order to confirm a case, you have to test it. So as we tested more and more and more, and we tested further out to those showing fewer symptoms, caught cases we wouldn't have before, our numbers continue to rise. Now on the medical side, we continued working as well. We had 140 drugs in development around the world, 11 of those in clinical testing, including the vaccine that came here in the United States to clinical testing, basically the fastest we've ever seen. Last week, we got data on Monday that the University of Oxford's coronavirus team had gotten approved for mass testing of 6,000 people. Now, usually you go into 100, 200, 300 people during those initial testing phases. It's smaller groups. But because this is a team who, remember, we call it the coronavirus, but it's COVID-19. It's a strain of coronavirus. This team had worked with prior strands of coronavirus, things like SARS, They were a step ahead. They had a running start coming into this. They had made progress. There had been testing on some of their prior vaccines geared towards this type of virus. So they got sped through, they got approved, and now they're doing their mass testing. They believe if that progresses as expected, they could have 5 million doses available by September. Then on Tuesday, Pfizer announces they're also in advanced testing with their vaccine. They believe they can be in emergency use by the fall, and they could be in mass production by the end of this year. Then Wednesday, we get Gilead, remdesivir, promising results shown from the treatment side based on their test. Over this past weekend, that got approved for emergency use now. And we keep making progress. I think one of the most important things to remember from the medical side, from our knowledge standpoint, is that every single day we're moving a step forward. We know something we didn't know before. We're never starting further back. And we've seen this progress on the medical side. I think, frankly, it's been amazing, the progress they've made. They've taken years of development and brought it down into months and sometimes in weeks. Now, we have the increase in the testing. We have the improvements on the medical side. Here in the United States, as we've seen with the other nations, we saw the numbers rising, then it started to slow. It looks like we peaked in the United States. It looks, we won't know until the future, but it looks like we're moving to the flattened, starting to decline phase. Now, as we've gotten into this phase, we've also determined, we've found that we can test for the antibodies. Just as Gilead got approval over the weekend for remdesivir, there was another company that got approval on antibody testing. This test, which tells us if you have the antibodies, which it's believed if you have the antibodies, you're less susceptible to recontracting, and if you do, the duration should be short and your symptoms minimized. We didn't know how many people had the disease because testing was limited. Well, now we can test for the antibodies, get a better idea. So we started to see that. Stanford University did it in Santa Clara, California. We had USC in partnership with LA County. We had Chelsea, Massachusetts, kind of the center of the outbreak in Massachusetts. And then we had New York City, the epicenter of the virus here in the United States. They all started testing their communities for these antibodies to get an idea of how wide this had spread. And the numbers came out higher, exponentially higher than people expected. LA County at the time said they had seen just under 8,000 cases. They believe that their real number based on these antibody tests was somewhere between 220 and 400,000 people. New York City, based on their testing, believes that 1/4 of their population, 1 in every 4 people, had it. So this spread earlier, it spread wider. That also tells us the mortality rate is lower than we initially anticipated. If this data holds as more cities and states test this, as they're doing right now, it looks like the mortality rate's probably closer to 0.5% than the 2 to 3.5%. Each day we're making progress. Each day we're learning more. All of this has allowed that conversation to start shifting from what else do we need to do to contain the disease to how do we start getting back, how do we start reopening the doors and start fixing that second threat, the damage to the economy. Now, I think it's going to vary a bit geographically and sector-wise. As we've seen during every prior recession coming out of it, we focus heavily on the areas that were at the center of the recession. Go back to 2008, 2007, it was the banking sector in 08, 09. And so during that, I mentioned they were undercapitalized. So we put an intense focus on them afterwards through regulation, through rules, and forced them to increase their balance sheets. Things like their Tier 1 capital ratio, their safe assets, nearly doubled their loans to deposits, lower their equity to total assets. They have a higher buffer on the equity side. Now these pieces, they improved the balance sheets of the banks. They made them stronger. At the same time, the Federal Reserve was doing the stress tests. These tests against their balance sheets, a simulation of a situation worse than 08, 09. And these banks needed to be able to withstand that to continue doing some of the things they want to do as publicly listed companies. things like pay the dividends. Now, that resulted in a much stronger balance sheet this time around. We've already seen them allocate loan loss reserves under the expectation, we all know there are going to be defaults, but the numbers they've put so far, around $25 billion, is still just a fraction of what they are tested against in the stress test. It's about 16%. Now, this time, well, last time it was the banking sector, and they got heavily regulated afterwards. They were kind of seen as the villains back in 08, 09. Now, it's a bit ironic because here we are in this situation, and they're being focused on as one of the major tools through their lending, through their activities to help us survive this period. But I think this time around, the groups that are at the center are the cures, the medical community. We had an aging population before. I think we're already going to see, if you looked at the ISM report that was out on Friday, the manufacturing report, one of the comments that was in there, coming from a production side, was that they're working on the PPE, the personal protective equipment, that orders are up at record levels. And there was questions about, are those short-term, are they going to be reversed as this eases? And they said, well, many of these contracts are long-term government contracts. They've committed towards long-term purchasing. We expected they were going to build up some strategic reserves of things like PPE, things like ventilators, to prepare for the future. We're getting those signs that is indeed the case, that those actions have started. Banks, hospitals, cities, states, the nation, internationally, there's going to be a focus coming out of this on the medical system to be prepared. There's going to be spending in these areas. Even as we see enter into the summer, and it looks like the heat, the humidity reduces transmission of COVID-19, we're still going to be actively working on the vaccines, on the treatments. There's going to be increased spending in those areas. That's going to help from an economic perspective get those sectors back to work. They're going to grow faster. They're going to grow sooner. Likewise, as we've moved from outside inside, we've moved online. I think there's going to be more spending, in the communication services, the IT community. We know now we need to be prepared to work remotely. That requires things like the cloud. That requires things like cybersecurity. Those areas, those sectors may recover faster. Oil has its own problems. Not only do we have the disease impacting the demand side, we have the situation with Saudi Arabia and Russia impacting the supply side. We saw, a week or two ago, we saw the negative oil prices. That was partially because of the futures contracts expiring and the lack of storage to receive those futures contracts and store them. But it's still going to be volatile. U.S. companies, they're pulling production offline. We've already seen the rig counts decline. Other countries are responding as well. But that timeline, there's still uncertainty there. We don't know exactly how long that's going to last. So some areas are going to be back sooner. Some are going to take a little bit longer. But we're at that point now where we're starting to reopen. As of right now, we have 18 states that have at least partially opened. We have another 7 who are preparing to reopen. So at that point, we'll have essentially half the nation in a partial reopen standpoint. Now, here in Illinois, with you in Michigan, we are going to be waiting a little bit longer. As our places on the West Coast like California, Oregon, Washington, Nevada, on the East Coast, we've got New York, New Jersey, Pennsylvania, Virginia, North Carolina. They're waiting a little longer. We're going to continue to watch the data. We're going to see how these other countries start to enter, the other states and countries internationally, how they start to grow, what the numbers look like, what their caseloads look like. But we're moving in that direction. I think May, we're going to start to see the economic data. The data is going to start to even out and start to move a little bit higher. June, I think we're back in growth. I think the second half of this year, we're going to see stronger growth in Q3 and Q4. Because of this drawdown in 1 and 2, we're still going to end the year down probably around 5 to 8% real decline in growth for the year. It's probably going to take us through the end of 2021 to get back to around the levels that we saw coming into this year. But I think, as we've seen in the past, markets move sooner. They move earlier. So I think the markets, I believe that they bottomed back on the 23rd of March, when the data, the scenarios from the medical side were showing the worst potential outcomes, when it looked like the shutdown may go into June, July, August. Then we saw progress, and that progress started to improve the market outlook. It started to improve the economic outlook, and I think we're going to continue moving in that direction. So we are in a standpoint right now from an economic perspective. The data is going to continue to be ugly. We're posting up on our website. We're doing high frequency data, looking at things, weekly jobless claims, weekly retail sales, rail traffic, steel production, hotel occupancies, TSA checkpoint data, supply of motor gasoline, which is the demand. And some of those numbers have started to tick a little higher. They're still down year over year, but they're improving week to week. And that's what we're going to continue to watch for. And I think the market's pricing more of the high frequency data over the economic data, the monthly, the quarterly reports, because of that lag. So we're going to continue to watch those, but we're positioning now. We're thinking about things as we start to see this opening. April showers bring May flowers. I think we're going to see some of the green shoots of the economy now as well. So let me stop there. You've listened to more than enough from the Economist talking for a morning, and let's go over to some of the Q&A. So I see one in here. There's a box, by the way. If you're going, there's an area to put in questions and answers. So one of the ones I'm seeing in that box is saying, with rumors of Wells Fargo going insolvent, how would that affect the market for distressed debt and the greater economy? We'll have to watch. One of the questions is going to be, if we start having issues with any of the banks, are we going to see a step in again from the government, from places like the Fed? The distressed debt and some of these other markets related to the debt, what the Fed has done over recent weeks, I guess almost now into months, what they've done to step in and provide liquidity, we've all seen that's brought some of the yields down. We've seen some of the spreads moved a little bit lower. Distressed debt, it moved with that. If you look at the high yield or the senior loan, as we started to see the Fed get involved. Now, those are an area where you need to look at where those allocations are, right? If you're thinking high yield, it's got a greater exposure to the energy sector than do, the investment grade, or obviously if you're looking at mortgages or municipals or whatever it may be. I think this is one of those times where considering, know what you buy. So if it's going to be on the debt side, where if it's index-based versus actively managed, positioning within that, I think this is one of those times that the active management has created some opportunities for it. But we'll continue to watch. We'll continue to watch all the banks. From the data that we've seen, from what they've announced with their loss reserves and their expectation for losses, they look like they're going to be able to weather this storm, but that's going to vary between groups. So, Jason, I don't know if you've seen any other questions come through.
I do. I have at least three other questions. Okay, so the first question I have is, you mentioned in your 5 pillars of economic growth that government debt is a potentially constraining factor on growth. The International Monetary Fund predicts that with the stimulus package, debt to GDP in the US is going to grow to 130%. It's at about 100% now, and even prior to the GFC, it was only at 60%. So do you see that being over, like in the next 2-3 years, being a headwind to growth?
So the next 2 to 3 years, no, I don't. As we move out longer, it's a greater concern. When I look at the impact that the debt is having from a short-term perspective, 2, 3, 5 years, the key number that I focus on is the net interest that we pay on the debt as a percent of our GDP. So you have the level of debt, which has been rising, but interest rates have been coming down since the 1980s. So if you look at our net interest payments, what we pay out on the debt right now going into this year is about 1.7%. Now, it was between 3 and 3.1% back in the 80s and the 90s. And if you think about it, if we have a 10-year note coming due today, I didn't look at where the 10-year was this morning, but I'm guessing it's somewhere between 60 and 70 basis points. If you think about what's rolling off from 10 years ago, that was closer to 3%. So as we continue to roll the debt, plus this new debt that we've issued this year, which is going to increase our debt burden, it's being done on the shorter end of the yield curve, and it's being done at incredibly low rates, right? 20, 40, 60 basis points. And so in a situation like that, historically, from our ability, what percentage of our output as a nation is going towards this debt payment, we're still within comfortable levels. We're actually kind of on the low to mid end of what we've seen over the past 60 years. Now, the concern, even before any of this started with the coronavirus and we did the additional spending, the concern was, well, what happens when those interest rates start to rise? Because as the interest rates start to rise and we're issuing new debt and we're rolling over debt, as it starts to move to higher rates, we're going to quickly move up to that 2.5, 3, 3.5, and we're going to get into kind of uncharted territory from a debt management perspective. But the average maturity of debt outstanding right now is between about 6 to 7 years. So even if we start to see a modest pickup in rates, which I'll argue I'm not expecting right now, because this situation that we've had, and for people that also went through 08, 09, even though we've started to see like M2 numbers, we started to see some of the inflation indicators tick higher, we're not actually seeing those money flows through the economy. And I think there's a greater demand now for safe assets than we've seen in a really long time. And if we continue to see a risk-off attitude internationally, and this U.S.-China trade conflict could intensify that, if we see that, I think there's going to still be a continued demand for safe assets, which is going to push down U.S. yields, because that's where people want to go. It could push up the U.S. dollar, but it could push down yields. So as I look out, that is my number one concern. If we look out 5, 10, 15 years from now, this debt management burden and what we do as the situation starts to improve and yields move higher. But over the next 2, 3, 5 years, I think it's going to remain very manageable.
Could there be another potential drag on growth? Someone has raised a question about the unemployment benefits that have been instituted are reasonably generous. Could it be a drag on growth that people are not incentivized to come back to work for moderately and low-paying jobs?
Yeah, absolutely. We've already seen it. Some of the groups, some of the restaurants and bars that were getting the PPP loans, one of the things, again, you have to have that 70 to 75% going towards the employees, and you have to get them around the levels that you were at before, and they were having a hard time getting people to come back to work. Now, you can't just quit your job to get unemployment benefits. You have to be fired in order to be eligible for the unemployment benefits. But the companies, particularly in the restaurant industry, have already reported difficulty in getting some of their people to come back. We're paying more, we're paying it longer, and if you are making more on unemployment than you were with a job, you're going to be more selective, you're going to be pickier coming back. So I do think that will be a headwind to seeing the unemployment rate move lower and a headwind to some of the economic growth. But I do think that as we move forward, that's not going to keep us in recessionary territory. We will see progress, but some areas are going to see a slower response. Now, some of those areas, if you think about it, that's going to be heavy in areas like the restaurant bar industry. Those were already going to be slower to grow because of the nature of that environment where you have a bunch of people in a confined location. They were already going to be slower to open than some other areas of the economy. But yeah, that incentive, at the end of the day, incentives matter. And that incentive that's in place with that, I think will slow the return back in employment.
So continuing with a sector by sector theme, one sector which had previously had slowing growth was auto sales. And we had a peak a couple of years ago, then we had a decline. But a panelist has raised the question as to whether this could actually be reversed. And two things: are people going to have more incentive for private transportation for safety reasons? And secondly, gas prices are low. But offsetting that, we are in recession, and typically auto sales are low in recession. So do you have any specific auto sector comments?
Yeah, so as we think about the auto sector, so what had happened with autos reaching about 13 million on the sales, typically with housing and with autos, they tend to be impacted by population growth and scrappage, right? Natural deterioration of the assets over time. And so we've seen kind of normal levels for their growth over time. And that 13, I think, was the domestic. I think we were around 17 for the overall sales, including the international. But those, they had started to level off a year or two ago, and they should have based on those population and scrappage metrics. Housing was the one that was kind of lagging behind. Are we going to see a pickup in the short term? Now, I think we will see a pickup in the months ahead because we're going to have delayed purchases of some of the autos. The dealerships have been largely shut down. The number we got, now that number that came out last week, around 8, the consensus expectation was 7. So it was the worst number that we've seen really in that history for the auto sales, but it still came in better than expectations. I think we may see some pickup. I think we could see some pickup in the intermediate term if we do see a shift towards private transportation, but I think we're going to have to watch it. I mean, we saw some things if we go back to 9/11 and we think about how psychologically it impacted people choosing what types of activities they were going to do, and there was concerns back then. Will the airports, will planes, will that ever get back to where it once was? And it seemed crazy then because people were so concerned, so stressed about that environment. But we did ultimately get back there and we set new all-time highs. I think over the medium to long term, I still think the demographic growth and some of that scrappage, the deterioration of vehicles, which has also been slowly shifting over time as we've increased quality on some areas. I think that's going to be the more dominant factor. I think housing is the one where they're getting hit more now. I think we're going to see that growing at a faster pace coming out of that because we need about 1.5 million new homes built per year. And we were consistently below that. We overbuilt going into 08-09, but we had made up that capacity. And as we continue to grow, I think that's going to be one of the ones that'll be quicker to come back.
That's a great comment. So you're seeing positive on housing, for kind of neutral on auto sales. Let's think about globally. You can hear my accent. Yeah. The Australian share market is down by 28% compared to 17% for the US market, despite having, that country is still counting the deaths on an individual basis. So the globalization impact of this is no more evident. And the question from one of our participants is that we're kind of under control in the US, but we've got strong growth in cases and deaths in other countries, Russia, Middle East, Africa, and South America. What do you see is the impact of those countries affecting the US?
Yeah, there's going to be some impact. There's going to be some impact as other countries are slower to respond. Obviously, it's going to have an impact on things like supply chains. Now, last year, because of the trade conflict that we had going on with China, many U.S. companies had already been starting to adapt their supply chains. So we had moved things like tech. We had diversified away from being heavily in China. We moved it to South Korea and Taiwan. We moved more operations over into Europe. We moved a little bit more into Canada, Mexico, some into Japan, and we had started increasing our activity with the UK as well. That's where our heaviest exposures are at. It will have a bit of a headwind impact. China or US is the biggest player, right? So it's been said when the US sneezes, the world catches a cold. It doesn't always work the same way in response. I think one of the things the US is going to benefit from, we're already seeing more movement towards production, that diversification, the supply chain. Companies were already in that mindset because of what was going on with China. They were already exploring their options for moving supply chains, for kind of beefing up the predictability, the reliability. Now, how much can you plan for an event like the coronavirus? You can't really, but they were already in the planning stage. And so now making some of those adjustments or speeding up that process, I think they're going to benefit from it. Now, from a market standpoint, when we think about some of the other countries and how quickly will they respond, what is the international outlook versus domestic? I think the international valuations in many places like Europe, their valuations are more attractive. But historically, the U.S. has outperformed international markets in environments where the dollar is strengthening. And I think even as we move from this coronavirus, what I'm looking at some of the data this morning and what the conversations are, this uncertainty now over the China trade conflict and how that's going to progress is still keeping that uncertainty there. And I think we're going to continue to see those fund flows into the United States, which again, that search for U.S. safe assets, it's going to push our yields down and it pushes our dollar up. So as long as the dollar is strengthened, as long as internationally we're in risk off, I think that's going to continue to support U.S. investment. Once we start seeing that confidence respond and we start seeing some of those outflows and the lower movement on the dollar is when I would be looking and saying, okay, now is the time to put a little more weight onto the international. And I know we're running up against our stop time right now, and I want to be respectful of everybody's time. I also have a commitment I'm going to have to hop off for in just a minute. But if you have questions, reach out to the CFA Society of Detroit. And I'm happy, maybe we can do another one of these or do a Q&A further in the future or communicate via email. But everything that we have a blog. We post everything on there. Everything we do is retail approved. There's nothing you need to have a login. You don't need to have an account with us, whatever it may be. We put all of our stuff out. I'm on the research side, completely separated from any of the products. Our focus is on evaluating this U.S. data and what we can see moving forward. And I appreciate everybody's time for being on here today. Thank you.
Thank you, Andrew, and thank you all the participants. We've had, between 50 and 100 participants at different stages of this presentation. That was very informative. Julie, am I signing off, or are you signing off this seminar? I guess I'm signing off. Thank you.
You got it.
Thank you for your time. That was very informative. And again, other questions for participants, you can send them directly to Andrew. You can send them to CFA Society Detroit. We will see you all again next time.
Take care.
See you later.